The Organization for Economic Cooperation, OECD, recognizes the need to better tax the digital economy and the fact that big tech companies need to be making bigger tax contribution. How will these be affecting Nigeria and how fair is the deal? I have with me two gentlemen in the studio. Mutwalu Msoni, he's a global tax advisor of Action Aid. You're welcome to Business Express. I also have joining me here Mr. Celestine, and Celestine Odo is the governance manager, Action Aid in Nigeria.
Thanks.
You're welcome to the program. Perhaps I will start with you, Mr. Msolo.
Sure.
Tell us about the OECD Tax Deal and your position about it.
Well, the OECD Tax Deal is part of the OECD's base erosion and inclusive framework work that has been done over the years, that is trying to probe, question and provide solutions for challenges with taxing the digital economy and other aspects of the economy as it is. It's trying to challenge the over a century of tax rules which only mean that we can only tax a company if it has got a fiscal presence within a country, and which multinational corporations have been taken advantage of because of the differences in the taxes for different tax jurisdictions. So essentially it has two pillars with it. The first pillar is looking at creating rules for which some of the profits from a company can be paid to different jurisdictions where the company is generating some of its revenue. The second pillar is basically looking at having a corporate minimum tax of 15%, which essentially means that all corporate bodies will be subject to at least 15% tax regardless of the jurisdiction where they are. So if you're operating in a low tax jurisdiction, another jurisdiction will have the taxing rights over you if you have not paid up to that 15%. If you've paid 2%, 13% will go to the resident country.
Okay, so how does this affect Nigeria? I'm going to throw this question down to Mr. Celestine. How does this affect Nigeria, and what do you think of the authorities' decision to refuse this particular deal?
Yeah, it's a deal that as a country we've been looking forward to over time, but the way it ended is not to the interest of the developing country. At 15% minimum tax rate globally, that's low. You know, presently for us as a country, we are 30%. Yeah, so what it means is that loss of revenue for us as a country, and this is a period that we are looking everywhere to see how we can fortify our internal revenue generation.
So who are we losing this revenue to?
Pardon?
Who are we losing the revenue to?
No, we are losing it to the multilateral organizations, MNCs and all that all over. You see, the thing is that, you know, ordinarily, these companies should be paying what we call fair share of tax. But with the backends of the global businesses, governments and all that, they are able to evade and avoid taxes within the area they operate. And given the nature of digital economy, it gets much more difficult, you know, to tax them. But with more unilateral approach, which countries can use, you know, to tax them, that would be a very good opportunity. But it's not just tax them. Initially, it has been the aspect of looking at their revenue, yeah, turnover, annual turnover. But that doesn't give us the actual revenue they generate, because they have a way, many ways of circumventing that through transfer prices and all that. So we are pushing to look at the data. Which data do you have in Nigeria? Operator, how many Nigerians are there operating within the digital economy? For instance, when you talk about Facebook, how many Nigerians are in Facebook? So using that data will be much more reliable than even the revenue that we are talking about.
Okay, now still sticking with the data, I will put this question forward to Mr. Msolo. And then one will begin to wonder, where was Africa when this decision was being taken if we're reacting this way now?
So you see, Africa wasn't included at the start. This is something that is being negotiated at the OECD Base Erosion and Inclusive Framework. After some period of negotiations, African countries were then put on board. But if you look at the outcome that has come from this process, it's basically undermining Africa's taxing rights. Africa relies 16% on corporate income tax in terms of all the income that we have. 9% is for OECD. In Africa, the African average for corporate income tax is 28%. So if we're looking at a global minimum tax of 15%, we're basically undermining what we're trying to solve, which is companies going to low tax jurisdictions, shifting some businesses that are more profitable to low tax jurisdictions so that they can be able to shift profits in terms of management fees, in terms of some of the service fees, and pay low taxes in these particular jurisdictions. The 15% is close to what was being advanced by OECD countries, the rich countries who are only 9% reliant on corporate income tax. It's close to Ireland's 12.5% corporate income tax, and very far from the African average of 28%. The global average stands at 24% in terms of corporate income tax, and our argument is for us to even harness the potential of having such a tax rule, it should be around 25%, if not coming to what stands as the African average. We were not at the table on initially negotiating, and even as we have been included, you can see from the outcome that this is not reflective of what the African continent would stand to benefit from. Nigeria currently has the significant economic presence order, which gives taxing rights to the jurisdictions for digital companies that they operate in. If signed on to the tax deal, Part 3 basically means that we now let go of those taxing rights, that potential revenue, and stick to lesser revenue to be collected.
Okay, now still sticking with the concerns around Nigeria, Nigeria is trying to build the tax to GDP ratio, and then we have this concern to address. And of course, there's a growing presence of Nigeria on the internet, the social media. People are doing a lot of trading across continents. So how will this tax deal be affecting Nigeria's revenue drive?
Well, for starters, the Finance Act of 2019, Significant Economic Presence of 2020, create rules for digital companies that are not physically present here to start paying some of their taxes based on their turnover. This is bearing in mind that before we had so much digitalization, people would come to TV stations to advertise. TV stations would pay their taxes. Now business is moving to digital platforms. People are advertising on Facebook, TikTok, and if Facebook and TikTok are not paying taxes in Nigeria, it basically means we're losing out significant revenue. With a global tax deal currently, it's saying that if your annual turnover is over 20 billion United States dollars, part of your non-routine profits, the profits above 10%, 20 to 30% will be shared based on the number of users in the country, based on the number of revenue. And our argument is, look, the significant economic presence rule for Nigeria, the Finance Act, will basically get more revenues than this global deal. This is why we're very critical of signing on to the global deal as it is, unless things are revised to the favor of Nigeria and other low-income countries.
Okay, great. And now, are there likely, I'll ask you this, Mr. Celestin, are there likely some agreements or treaties that we've signed with these major economies in the past that you feel are going to come into play here?
Yeah, yes, in the past, yes. For instance, if you look at, okay, let me state it this way. For instance, this process, Nigerians, the developing countries, weren't part of this process, negotiation process, and this has been our challenge over time. So you find out that the voices are not actually what is being represented, you know. So for us, it's a deal that is not giving us, or will not give us, what we want in the long run. Yeah. So unlike other treaties we've been signing, double treaties and all that. The thing is that some of these treaties are not even beneficial for us. And you find out that it's the companies, the multilateral organizations, coming in to operate in the countries that eventually are the gainers, yeah, through double tax treaties happening all over Africa,
Is there a way this can become beneficial?
The only way it can become beneficial is through expanding the process so that the countries really put in their voices as they affect them as countries. It's not like OECD, negotiating on behalf of other countries. Yeah, but as I mentioned earlier, using unilateral approach on taxation, to tax the digital economy will be the only way it will be beneficial for us.
So now we're finding a way to balance ourselves. We on this side, and of course the other bigger economies at the other side. Where do you think a middle point will be reached? And do you see them giving way to take onto this dimension being brought
before? The global dynamics, they don't give away. Rather, they look at the way of getting more, in terms of what favors them. Yeah, but we don't give up. The process continues, and we're supporting countries. For instance, this Nigeria holding on to sign on this, unlike Nigeria that always rush to sign. But this aspect now, and the awareness is there. So you find out that Nigeria is restricting from signing it, and we hope that it will not jump into signing this also.
Okay, Mr. Masolo, can you also tell me what will be your recommendations for the African tax administrators? Of course, they are now neck deep into this.
The Africa Tax Administrative Forum has recommended for countries not to rush into the global deal, and some of the concerns that have been expressed by the Administrative Forum is, one, the global minimum tax would probably lead to a race to the minimum. It's undermining the tax rates for African countries. Secondly, we need to share both routine and non-routine profits. Sharing just what's above the 10% is undermining other countries where these companies generate most revenues. It's based on an assumption that these revenues are being generated in probably the headquarters of these companies where they're generating more revenues. A UN tax body, the United Nations tax body, potential UN tax body, would be a good negotiation platform for such a deal going forward. We have learned from the past, from the double tax treaties my colleague Celestine had mentioned, which were drawn from the OECD model. They were not beneficial for low-income countries, for third world countries, for African countries. What was more beneficial is what was negotiated in terms of a model treaty at UN level. The UN needs to come in with a global tax body now and help nations be at an equal footing to negotiate such a tax deal. I don't think it would be very beneficial for us to sign on to this, considering we have some unilateral measures that are in place and will generate more revenue.
Okay, before I let you go, are you optimistic it's going to work?
I'm very optimistic it's going to work. Nigeria is a very big market, and if Nigeria is staying away from this, Kenya as well, it will lead to a very big movement that will put its foot down and say, we're only going to sign on to a tax deal that is beneficial to us, because over the years, tax evasion, tax avoidance has impacted on African nations more than other nations, in the sense that we need these revenues more for development.
Okay, so before I let you go also, Mr. Celestine, what do you make of Nigeria in the long run? In a very, very short one sentence, how do we handle tax in the digital economy?
Yeah, Nigeria needs to remain strong and need to move very swiftly in line with what is happening globally to tax. But we are very happy that even the FIRS on this aspect is very strong. They're already moving. We've been working with them, so they should continue. And like we've already recommended to them in terms of taxing the digital economy, we don't wait for the global process, because as we are waiting, we are losing much revenue. And Nigeria is a big market in all aspects. When you look, in fact, data is more than petroleum. is more than crude oil now. So once you have data, you hold a lot of weight. It's an asset. Yeah, so Nigeria really need to remain so. And we are also happy the way WhatsApp and both WhatsApp and DATAF are moving swiftly.
Okay, thank you sincerely, Mr. Celestine Odo, the Governance and Manager Action Aid Nigeria, for coming on Business Express this afternoon. I also want to say thank you to Mr. Mutwalum Soni, the Global Tax Advisor at Action Aid.
Thank you.
You're welcome to Nigeria.
Thank you.
And I hope we're going to have some pepper soup and jollof rice.
Sure.